Um, Good evening, friends, and thanks for joining us. On behalf of Bajaj Finance Limited, I'd like to welcome you. Friends, it is a continuous and consistent endeavor to bring latest news and knowledge from the world of mutual fund for our investors, and for which we keep inviting leaders from the mutual fund industry to come and share their expertise and knowledge with us. Today, we have with us Mr. Nikhil Rungta, co-CIO Equity from LIC Mutual Fund, who will talk to us about NFO of LIC MF Manufacturing Fund and the market outlook. Mr. Nikhil, I'd like to welcome you for today's session.
Thank you, Rohanji, and also thanks to all your viewers for having me here.
It's a pleasure to have you, sir. Well, friends, before we begin, I'd like to give a brief introduction about Mr. Nikhil. He's a seasoned investment professional with an extensive experience in managing diverse investment portfolios across all formats. Before joining LIC Mutual Fund, he has worked with respected brands like SBI Pension Fund, family offices, Nippon India Mutual Fund, Bajaj Alliance, Life Insurance, Anand Rathi, Shares and Stockbrokers, Started Chartered, Religare Capital Markets. By qualification, he's a chartered accountant and an MBA finance from NMIMS. Well, friends, before we begin, I'd like to quickly give a brief about what is an NFO. Well, friends, NFO stands for New Fund Offer. It is the initial sale of a mutual fund scheme by a fund house, and the NFO allows the fund house to accumulate the initial corpus so that the fund managers can build a portfolio based on the investment objective of the scheme. Fund house generally offers a subscription period of around 10 to 15 days, which is called the NFO period. And for LIC MF Manufacturing Fund, the NFO period has already started. Friends, without wasting much time, I'd like to hand over the stage to Mr. Rungta. Sir, I request you to take it ahead from here.
Thank you, Rohanji, and thank you everyone for giving me your time. Rohanji, may I request the presentation?
Yes, yes.
Perfect.
So we have it live.
So yeah, so I'll start with the market outlook. I'll touch base upon the domestic outlook as well as global outlook. Post that, I'll take you through our manufacturing NFO. So to start with the market outlook, so these are the key arguments which are generally given for the market: deglobalization, demographics, major capex, rural consumption is improving from here on. Wallet share of consumption would continue to increase. I'll just talk about a couple of points which generally people ask me whenever I meet any of the distributor, investor, or MFD. They ask me just one thing: are the market expensive, or are the markets at peak? Should we invest now or should we wait? So let me tell you one thing. When we talk about markets being expensive, we talk about the valuation. So in terms of valuation for large cap, we are currently at median average of last 10 years. Same is the case of the small cap. For mid cap, we are slightly expensive, but why is that so? Because 15 to 20% of the mid cap index are so expensive that it's taking the entire mid cap index to a upper band. You exclude those 15 to 20% mid cap scripts, then your mid cap index is also reasonable. So I'm repeating, it's reasonable, not cheap. Secondly, the chart which is there is of Nifty. The last 10-year average is 20 times. Right now we are at around 21 and a half. You can definitely say that we are expensive by around 5-7%. But there are a lot of things which have changed. Our government's balance sheet is clean. Our bank's balance sheet is clean. Our corporate's balance sheet is clean. And we have very good visibility for the growth for not only for a couple of years, but for 5, 10, 20 years. So definitely these valuations are just a number now because we have long runway to go. Coming to global, for global, definitely across the board, be it India or be it global, every day we are touching new high. And in terms of new high, let me put it this way: the global risk continues to remain risk for the Indian market as well. This is what I put as my major risk. One is global recession. So US have been talking about the recession fears. Everyone is talking that since there is recession, so we had seen 50 bips rate cut. But as of now, we don't see that. Inflation is coming under control. Your growth is also not as bad as it could have been. For India specifically, if we see, we don't see much issues. In fact, when people ask about when RBI will cut the rates, I say that why should RBI cut rate? Neither we have a problem of inflation nor we have a problem of growth. So they have ample time to wait for proper time to cut the rates. In fact, they should wait for the issues to prop up in India, because this is like a arm in the hands of RBI, which they should use only at the proper time. So definitely these things are there, but yes, uh, if not now, then in 1 to 2 quarter, RBI will also have to cut rates just to give more growth power to the economy. Escalation in geopolitical situation is another issue which we believe, but last 4 years have shown us no matter what geopolitical issue is there, we definitely come out with flying colors. Specifically, why is that so? Because we are looking inwards. The India consumption story is also rising now. Lastly, delay in implementation and execution of government policies. A lot of manufacturing, capex, and other cycles in India are dependent upon the implementation and execution of government policies. What we saw in the past 10 years is giving us the result in terms of growth of the corporates now over the next 10 to 20 years. So these remains the key risk for India. But yes, in terms of market, valuations are decent. Market is at peak, but our valuations are not. Uh, it continues to go up. Another question which comes on the market is there a liquidity issue? I mean, because of liquidity, is the market flying high? Let me put it this way. Liquidity is there, but there is a general inflow of money which is coming in the market now. It's not that it's the lump sum, it's the SIP which is coming in the market. And these money is coming because this money is coming in the market because those investors are also seeing good growth in Indian market. That's the reason. I mean, it's not that the liquidity as well. So what I believe is things are good for India. Globally, of course, there could be issues, but for India, definitely we are at a good path as of now. Coming to our manufacturing fund. So, what is manufacturing? Is the process of converting your raw material into finished goods using machinery, tools, and human intervention. So, those machinery, tools, and human interventions are the processes of manufacturing. And this manufacturing is used across industries. People generally say that
Sir, I guess your screen is now freezed. If you could see, slide is not moving ahead.
one second, it's not moving.
Even the screen, your screen is also frozen.
Because I can see the screen moving.
Okay. Well, ठीक है कोई नहीं. Mega, can you again upload this thing? Let's see. Yeah, now it's better. He's live again.
Okay.
PPT presentation is not uploading.
Should I stop it and reshare?
Yes, you can reshare if it's possible. I'll also try it from my end. Just a moment. Yes, yes, we can see the screen now. We can move
Okay,
ahead.
perfect. So this actually is what is manufacturing. So this is actually a process of converting your raw material into finished goods, and these machinery, tools, and human intervention, these actually are the process of manufacturing. And this manufacturing happens across multiple industries. People generally say that X, IT, and BFSI, everything is manufacturing. Let me put it this way: why should I exclude BFSI? Because BFSI actually lends for this manufacturing and capexes. So aren't these BFSI also indirect exposure to manufacturing? So actually this scheme is everything ex IT. Second, people say that this is a thematic or sectoral. Let me put it this way: this is neither thematic or sectoral, according to me. Of course, on paper it's a thematic one, but it's a core equity ex IT, because I can do everything here. It's multi categories. I can buy large cap, mid cap, small cap. I can buy every industry ex IT. In fact, in IT also, if I go in the supply chain part of the IT, then that also becomes part of manufacturing. So actually, this is a core equity diversified scheme which we generally talk about, and should not be a issue for us. And this is a multi decadal story now. It's not just couple of years story. How it has to be multi decadal, or how is it? I'll take you through those slides. This is manufacturing of the Indian economy in the past 10 years. The growth rate has been low because we were focusing more on building infrastructure for these manufacturing. Now that these infrastructure have been built, the next 10-20 years will be focused on manufacturing. What are the growth imperatives for Indian manufacturing? Sufficient affordable workforce, low cost energy. So these thing is known by everyone. Shifting supply chain and consumer market. I'll specifically talk about one part: sufficient and affordable workforce. So this is on the next slide. So my slides are visible, right?
Yes, sir, they're visible.
Okay, perfect. So this is on the workforce. So I'll take some time on this one. The top left hand chart shows the increase and decrease in population, working population in the next 20 years. We can clearly see that in China, Europe, 10 crores, 4 crores people are going out of the working population. In India, 18 crores people are getting added to this working population. So, first thing foremost, what option do these guys have? The only option over next 20 years is India, because nowhere else you have this type of working age population coming in. Second, there was a report by Apollo Capital, an international entity. They predicted that China's population will peak out in 2031. It actually happened in 2021. And since past 2 years, China's population is declining. Most important one statistics which I read there, and I also was not aware of that particular statistics, that China's productivity ratio, human productivity ratio, is 1. For Japan, it's 1.2, and for US, it's 1.4. So till the time I read that report, I was not knowing that China's human productivity ratio is lower than Japan. I don't know how many of you know that particular thing, but for me, this was revealing statistics. So I just thought I'll share with you guys. Uh, this is the key reason why China removed their one child policy in 2016. Despite that, in the past 8 years, there have been no improvement in the human production ratio of China. So we believe that this labor issue is the biggest one, and hence this will play out primarily for the companies moving away from China to India. The top right hand corner shows the percentage population in terms of working population. India's working population is around 19% of the world, and manufacturing output is just 2.9. And this manufacturing output exclude the IT services. So in next 20 years, this 19% would move up to 25, 26%, and manufacturing output will increase somewhat. I mean, there has to be some mean averaging. So lot of scope for India because our base is small. Another thing is our power cost is amongst the lowest now. So that is an important thing. One more thing which I wanted to highlight here, when we talk about the population, or when people talk about China plus one, that companies are moving, doing China plus one, and they are moving to Vietnam, because that's the key question which we come across, that companies are moving to Vietnam. Let me give you one statistics. This is a World Bank statistics. In 2023, a total of 28 new MNCs set up their shops in India. Out of that, 10 were from US and 5 were from South Korea. Same statistics for Vietnam. Last year, calendar year 2023, 23 companies set up their shops in Vietnam. 14 were Chinese. So this is what people have understood. This is a global data, and that's the reason the Western region, Western nations have also understood, and that's the reason why we are seeing duties being imposed not only on Chinese goods but also on this Vietnamese good. And hence we believe this China plus one is a big story. Now we are talking about Europe plus one, exports, like high-end exports like defense and all, aerospace, which we have started. Consumption is a big thing which is going on in India. So lot of scope for this manufacturing to pick up. Coming to the next slide, government's focus on manufacturing. This is basically the PLI. This is how it has been distributed. Total 2,70,000 crores of PLI being distributed. 28% in semiconductor. And why is government doing this? Because they want to make India as a manufacturing hub. You know how China became a manufacturing hub. In 2004, when they tied up with WTO, they invited these MNC to come and establish their shops in China. So these MNCs asked, where will we get land? The government said, we'll give you. Laborers will give you. Power, energy will give you. Same thing is happening in India now. Government is welcoming them with open arms. Land, there is a fight going on between states that we will give you land. Laborers, we have ample of them. Energy, power, we are very competitive right now. So what happened in China in 2004 is happening in India now. And why is it that China is known as a manufacturing hub, or the hub for quality products? Because when these companies came in China in 2004-5, these local Chinese companies had to compete with these MNCs, because these MNCs came up with their own technologies. So the local Chinese manufacturing units also improved their quality of their output. That is what is happening in India now. The output quality of India will improve because of these MNCs coming in. That in turn will make India as a manufacturing hub. This slide clearly states how China is losing market share. Of course, this is just the US import from China as a percentage of total imports. But why did it happen in the past 6-7 years? There also it's a story. I mean, the Chinese government announced that at the time of 100 years of their independence, that is by 2049 year, China will become the largest economy across the globe. What happened? I mean, this statement was not liked by the Western nation, and they said you will be the largest economy, so you will overtake us as well. So we'll not import from you. So that is what happened. Mr. Trump was the president at that time, and he started imposing duties on Chinese product, and that is what we are seeing. The US import from China is going down. Categories where India can gain against China, lot of scope. I mean, electricals, China currently is 28 times of India. Nuclear reactors, I mean, across the board we have opportunities. Vehicles 9x, iron and steel 10x, optical medical equipment 14x. Across the board we are improving right now, and we have lot of scope. This is the manufacturing output and market share globally. India is just $0.5 trillion out of total $18.7 trillion, which is just 2.9%. So since our base is very small at $0.5 trillion, I mean, even doubling from here will not take a big issue. I mean, we just need $0.5 trillion more. One of our minister, Mr. Prabhu, said a couple of days back that we want to double our economy by 2030. Doubling economy in next 5.5 years means you have to grow at around 14.5% in nominal terms. What does that conclude? Today we are growing at around 12-13% nominal GDP. We will be growing at 14.5% as per the comments, and you exclude around 5-6% of inflation. Our real growth rate would be 8-9%. That's a huge number. Similarly, you talk about the Prime Minister plan of making India a Viksit Bharat by 2047. We have to increase our per capita income from $2,600 to $18,000. That's a big number. I mean, 6x at the ground level, at the Aam Aadmi level. So think what type of growth we'll see at the corporate level. So lot of opportunities, lot of avenues. These are scalable opportunities which we have. Here, I'll highlight a couple of these things as well. India's export of electronics goods increased 3x in the past 4-5 years because of this PLI. Same is the case with defense. It's 2.5 times in the past 3 years. Of course, question comes: aren't defense expensive? Is there value still left?
Still left.
Let me tell you one
That's what I
thing.
was going to ask.
Yeah. So let me tell you one thing. What is value? The price you pay, and the value the person who is paying the price sees in that. So if I compare our defense sector in India, that's today trading at around 35 times multiple. 2.5-3 years back, they were trading at 10 to 15 times multiple. I agree they are expensive compared to their own history. Let me compare our defense sector with US defense sector. We have growth, they don't have growth. We have visibility, they don't have visibility. We have order book, they don't have order book. And we have the path over next 3-4 years, what could be the numbers coming in by our defense companies. US don't have that. And US defense sector is trading at 80 multiple, and we are trading at 35 only. So compared to them, we became cheaper. And compared to our own history, we become expensive. So that is what value is. Where, with whom, and how you compare define what exactly is the value of the sector or the corporate. So a lot of scope is there. It depends upon when and how you are comparing. These slides shows how we as LIC Mutual Fund Manufacturing Scheme would be different over the others. Three pointers which I'll point out. One, will be focusing more on the emerging themes. The young companies, younger sectors which are coming in. Of course, they would be primarily in small and mid caps, because the large top 100 companies don't leave their slots for these new companies to come in. So they have to come in, they have to come out with their IPOs in the small cap and mid caps only. But yes, those things will also be there. But our main focus would be on these emerging themes. In other diversified schemes, when you look at these emerging themes, generally 3-4% of the total portfolio. It would be very high for us. I will not give you a number, but yes, this would be our key focus area. When you compare our index, the manufacturing index, along with our peer manufacturing schemes, you will see that they have the holdings like Maruti, Tata Motors, L&T as their top holdings. My view is, if you want to go for these, why not any large diversified scheme? Why a manufacturing scheme? Because you can get those things in a large diversified scheme as well. So that's the key reason. Of course, those things will also be part of our portfolio, but it would be more to do with to give stability to our portfolio rather to make alpha for our investors. Our alpha will be made from these emerging themes. Emerging themes, of course, people ask me that, do we have companies? Of course, we do have companies. When I talk about just an example, semiconductor, we just don't talk about semiconductor. It's the entire supply chain of semiconductors. Today, when we say a word, use the word semiconductor, what comes to our mind is that it's a green chip with a circuits on that. But in manufacturing of that semiconductor, a lot of ingredients go into that. One example is very high purity water. The water has to be as pure as less than 5 ppm. That's a technical term. So that water has to be manufactured and purified. No company in India manufacture that water. That's the reason we have not been able to manufacture semiconductor till date. But yes, one chemical company in Gujarat have cracked this technology at a lab scale. Now they are working to crack this at a commercial scale. If they are able to crack this at a commercial scale, you see the TAM, which we say total addressable market for that company, which today is 9,500 crores, increases to 1,10,000 crores. So that's the type of opportunity which we have if we are able to crack anything. And semiconductor, when I talk about this entire supply chain becomes the semiconductor thing. I mean, in this chemical company of Gujarat, should I tell that or give a name of chemical company or should I give a name of semiconductor company? So I'm also confused. But what I know is this company, be it chemical or semiconductor, it will be part of my emerging theme. So that is what we are focusing on. So this is the first key differential in our scheme. The second key differential would be we'll be focusing more on the PEG ratio, price earning growth ratio. The range would be in around 1.2 to 1.8 at the portfolio level. Why 1.2 to 1.8? Because at 1.2, we believe a company below 1.2 could be a value trap. So if it comes at 1.2, it means it has passed through the process of value trap and now it's a growing company. Why limiting ourselves to 1.8? Because we believe at 1.8, a company beyond that would become too expensive. So that's the range which we'll maintain for our portfolio. The third key differential is our bottom-up research. So that is what we'll be doing across the board. What's the manufacturing opportunity for India? China plus one, I spoke. Europe plus one is now emerging. I mean, today morning, one of the chemical company have announced that they will be shutting their plant in Germany. 2 weeks back, a auto company announced that they'll be shutting their plant in Europe. So those things are also shifting to India. So China plus one is going on. Europe plus one have started. High-end exports like defense and all, CDM and CDMO defense. Uh, Around a decade back, we were not supplying any defense to anyone. But now we are exporting it to around 12 to 13 countries. Another 10 to 11 countries inquiries are going on. So if we are able to convert them as well, we'll be exporting our defense to 25 countries. That's a big opportunity, big policy change. So those things have started. Import substitution, your make in India is definitely there. But most important in all these five is our domestic demand, the consumption. So capex is what is driving India since past 3-4 years. Consumption is what we are seeing now in the past couple of quarters. So if capex plus consumption fire both the engine, if they fire together, no one can stop India to become a Viksit Bharat. In fact, in China, when we talk about manufacturing opportunity, around 60% of the China's production is consumed in-house. So that's the type of opportunity which we have, because for manufacturing plus our population, there would be huge demand for consumption. Why is India becoming amongst the top 5 revenue generating countries for most of the MNCs now? Because India itself have become a very big market. So not only for the manufacturing and capex, but also for consumption, India is a very big market, and this would also be a key growth driver going forward for us. Last but not the least, uh, we talk about these manufacturing. Then government of India, I mean, manufacturing as a part of GDP, if we talk about, it was 17% a year back. Today it's around 15.5%. Highest in India, highest contribution is by services sector around 55%. Next is agri at around 26%, and manufacturing is around 15-16%. This is altogether opposite of what we have seen globally. Manufacturing highest, followed by your agri and services, and then agri. So in India also, we are increasing the share of GDP, share of manufacturing in GDP. Government have already announced that the share of manufacturing in GDP to increase to 25% from current 15.7% by 2030. So not only long term, but even if I say medium term, that is next 5.5 years, two things will happen in India. One, our own GDP is increasing or doubling. Second, the share of manufacturing in that GDP is increasing from 15.7 to 25%. So double growth engine for manufacturing in India. So that is what we are trying to say, that manufacturing as a theme is very big, a long decadal theme. Of course, there could be some hiccups, some volatility, some rest, which a couple of sectors might have to take if they have run up significantly. But yes, it's a long drawn story, and it's not just 18 to 24 month story. Last but not the least, people say that are we late in launching this manufacturing scheme, because a lot of people have already launched. Let me give you a couple of data points on that. One, this category today is just around 34,500 crores. So given what type of opportunity India have, this would be just a drop in our ocean. Second, what we know is even after us, there would be many people coming up with this similar type of NFOs, because it's not just I mean 4, 5 or 10 players who can take the entire share. There is a huge scope for not only 10, 12, but entire 46 AMCs which are there in the market. So this theme actually is a core diversified scheme, non-sectoral. We will invest across sectors. We will invest across market cap. Looking at the valuation, we'll be focusing on PEG ratio, and of course, these would be the key emerging themes we'll be focusing on. In terms of objective type and allocation of assets, these are there. I mean, 80% would be minimum equity. Investment strategies, focusing on companies engaged in manufacturing activities that are well placed to substitute India's import, make in India initiatives, export goods manufactured in India, and of course, the new age technology solutions in India and abroad. Who would be the fund manager? Mr. Yogesh Patil, our CIO, and Mr. Mahesh Bendre, he is the fund manager. So, to give you a brief, Mr. Patil and Mr. Bendre, both of them are also managing our infra fund. Our infra fund is currently in Q1 in 1 year and 3 year. In last 1 year, it has given an absolute return of around 76 odd percent. So I just thought I'll highlight that because that's important. The same people will be focusing on these things. Coming to the fun facts, these would be part of the systems. Your it would be in terms of riskometer, it would be very high risk category because almost every equity scheme is in high risk category. And this was on manufacturing, but just wanted to conclude on the point that it's not just 1, 2 or 3 year story. It's a 5, 10, 20 year story. I believe till 1990, till the time we become Viksit Bharat, this theme will continue to grow, and our share in India will continue to grow. And this is what we are focusing on.
Hello, sir. Hello, we lost you. Hello, hello. Well, audience, I believe we have lost Mr. Nikhil due to some technical issue. Hello, hello. You're back?
Yeah, yeah, I can hear you.
And we thought the screen was frozen again. So, well, sir, for the audience, if there are any questions, so, sir, there are a lot of young investors who use our platform to invest in mutual funds. Uh, how would you recommend them with respect to their investment strategy? How would this fund become a part of their investment portfolio? And what should be the way in which they should start investing in this fund?
So first and foremost, the way they should start focusing is they should give at least 3 to 5 years time horizon, because when we talk about a manufacturing, what we get into our mind is that we have to set up a plant. So setting up a plant itself takes around 4, 5 years,
Yes.
and post that, commercialization of that and earning revenue from that takes time. So you should come into this picture or in this theme primarily from a time horizon of at least 5 years. I mean, it's not that before 5 years you won't get the return, but it's more to do that in 5 years you will start getting a stable and consistent returns.
Returns.
Second, if the investor is, from the investor perspective, they should think about their riskometers, their risk reward, how much they want to categorize their savings into sectoral or thematic. For me, it's a co-diversified scheme. At the full-fledged portfolio level, if you ask me for a young investor, I generally tell them that around 40 to 50% of your total investment should be in multi-asset or balance advantage type of scheme. Around 30 to 35% should be in core diversified scheme, and around 15 to 20% should be in your sectoral or thematic. But yes,
Matrix.
for me, this scheme is part of core diversified XIT. Everything becomes part of this scheme. So this should be part of that 30 to 35% where you put in your large cap, mid cap, small cap, those type of funds. And yes, definitely it should be part of your theme at least for next 10 and 20 years.
Okay. Well, I guess there are no questions. Audience, if there are any questions, you can please ask. Meanwhile, sir, there were a lot of questions which came to my mind, and it was like कि you were
Please.
answering all the questions. जो भी मेरे दिमाग में question आ रहा था, you were already answering them. Uh, well, so we'll wait for one second. Meanwhile, sir, well, I'll have my personal question for you. If while it's a high risk, so since you also highlighted the infra front, which has given such a high returns over last 1 year and 2 years, uh, and you indicated the same fund managers, managing this fund. So, do you? So by this, are we expecting a similar kind of a future for this particular fund so that our audience is also excited?
See, I don't want to give you a number, but what I'll say is we'll try to be in Q1 or in upper Q2. That's what our target is because we also invest in the same market, which is very volatile. If market goes down by 20-30%, we cannot be away. But yes, we'll try our best to be in Q1 and upper Q2.
Right, sir. I feel there are not many questions from the audience as of now. Well, friends, I'd like to wrap up this session right now. So, thank you for such an interesting session, and it was quite engaging. You highlighted all the macroeconomic factors, all the internal factors, the government policies, how this fund, which is focusing on manufacturing sector, will play an important role in wealth creation for our investor. The expertise and the experience of the fund managers and their past performance with other funds will play a very important role for our investors to make investment decision in this particular fund. And at the same time, how the China plus one story and the Europe one story, the internal consumption growth which India is having, with all the other factors which are there, the Bharat story is also looking very positive. Considering all this, this becomes an ideal choice and also an ideal time for investors to participate in this particular fund. I would request all our viewers to please visit our website, please download our Bajaj Finserv app and explore the mutual fund section. And inside the mutual fund section, there is an NFO section where you can see LIC Manufacturing Fund being listed. It is till 4th October. I know now the Shraddh period is going on, but friends, third ko khatam ho raha hai Shraddh. So, third, fourth, I think a lot of us will, participate and explore if you want to invest in this particular fund. Uh, if there are any questions, any queries, my friends, you can leave a message or comment on the given post. Our team of experts will come back to you with all the answers which will help you make the right investment decisions. Before we sign off, I will request Mr. Nikhil if there are any last few words that you want to share with our audience.
So the same thing which I started my presentation with, our market is at high, but our valuations are not at high. And most important, don't try to time the market. The day you decide that you want to invest, Just invest on those particular day. What maximum can happen is you will take 6 to 12 months extra. That's all. Else you might miss the rally. So don't wait and don't try to time the market.
So true, sir. It is getting reflected in number of SIPs that are getting started, plus at the same time the number of demat accounts getting created every month. So yes, I believe the even the common man is also want to take and enjoy this rally uh, to help them create wealth for themselves. So friends, Bajaj Finance also wants to be the part of your growth story. Uh, Please download the Bajaj Finserv Mutual Fund app and also explore the mutual fund section on our website. We want to partner with you and provide best of our services to help you create wealth for yourself. Thank you, Nikhil sir, for joining us today. Looking forward to do many more sessions with you. Thank you, audience, for joining us. This video will be available on the YouTube channel and on the Facebook. You can save this and visit and watch it again and share with your loved ones and your friends. Thank you, sir. Thank you, people. Bye.
Thank you, Rohanji. Thank you to your viewers as well. Thank you.
Thank you, sir.